The stock market is currently closed for the weekend. LUCID Group Inc., trading under the ticker symbol LCID on the Nasdaq, finished its last live trading session on Friday, May 29, 2026, at an exact closing price of $6.53 per share. This represented a microscopic intraday drop of 0.31%, losing 2 cents on the day from its previous baseline. If you look at the after-hours data ticking away as the weekend set in, the stock experienced a mild layer of additional volatility, settling with a slight upward tilt of roughly $0.09. This put the final quiet baseline around $6.62 as trading went completely dark until Monday morning. While a stable close might lead some casual observers to believe that this electric vehicle maker is simply drifting sideways in tandem with broader automotive trends, the underlying action tells an entirely different story. Institutional volume blocks have quietly shifted, and retail sentiment is fracturing over a hidden technical divergence that most standard market commentary is completely ignoring. The immediate reality that challenges the common narrative is the growing friction between LUCID's engineering achievements and its structural capitalization. Most retail traders looking for online investment help look at the high-end vehicle specs and assume the company is simply a smaller version of Tesla stock or a direct rival to high-end legacy brands. However, look closely at the institutional order flow through platforms like Interactive Brokers or Fidelity Investments during the final hours of Friday's session. You will see a massive buildup of options open interest clustered around far out-of-the-money put options alongside a sudden surge in short interest borrowing fees. This shows that the smart money isn't just betting on a routine luxury car cycle. They are positioning heavily for a massive structural showdown regarding the company's reliance on foreign sovereign funding. The broader expectation in the market right now is that the Public Investment Fund of Saudi Arabia will indefinitely bankroll the company's losses, creating a permanent safety net for anyone who chooses to invest online. The reality, though, is that this massive financial backing creates a persistent dilution loop that effectively caps the upside for standard individual brokerage accounts. This key dynamic alters how anyone using an intelligent portfolio or automated trading platform should evaluate this asset. Let's establish the common ground to see exactly why this tension exists. The consensus view on online investing sites is that the premium EV sector is undergoing a standard trial by fire, and the companies with the absolute best range and efficiency will naturally scale to dominate the upper tiers of the market. People open up the Robinhood app or log into SoFi Invest, look at the sleek lines of the luxury sedans, and see an obvious winner based on pure specifications. They think that because the product achieves 500 miles of range on a single charge, the corporate equity must eventually reflect that technological lead. But when you challenge that assumption with hard financial analysis, you see that engineering excellence is currently being crushed by a brutal cash burn rate. Every single vehicle that rolls off the assembly line costs significantly more to manufacture and distribute than its final retail sticker price reflects. This creates a fascinating paradox where higher production numbers actually widen the quarterly net loss instead of narrowing it, a reality that completely breaks traditional automotive scaling logic. Let's look directly at the recent stock movement and trading mechanics to understand the immediate pressures. Throughout the past few weeks, trading volume has hovered around 20 million shares daily, which sounds substantial but actually reflects a significant drop from the heavy liquidity seen during its peak speculative periods. This shrinking liquidity pool means that even minor institutional blocks routed through the Interactive Brokers platform can cause sudden, sharp percentage swings in the daily price. During the early part of this week, the stock attempted to mount a minor rally, driven by speculative chatter on various investing sites regarding potential integration with autonomous software networks and a rumored pilot program for automated urban transit. This brief surge caused a wave of retail buying on platforms like Robinhood, where fractional shares and easy access can amplify short-term momentum. However, that entire upward movement was met with aggressive selling pressure the moment it brushed against key moving averages. Institutional desks used that brief liquidity window to trim their exposure, effectively using retail enthusiasm to exit positions without tanking the daily spot price. Macroeconomic pressures are also hitting this stock with unique severity compared to broader market giants like Apple stock or Nvidia stock. Higher sustained interest rates have fundamentally altered the luxury consumer profile. When capital is expensive, the target demographic for a $100,000 electric vehicle shrinks rapidly. This directly impacts the company's order backlog, forcing a reliance on deep promotional leasing structures and aggressive financing incentives just to keep delivery numbers looking stable on paper. Look at the data provided across major brokerage ecosystems, from SoFi Active Investing Metrics to Fidelity Brokerage Research Reports. The average days to turn metric for these vehicles on showroom floors has steadily crept upward. This signals that demand isn't just softening, it is hitting a hard structural ceiling. Institutional analysts are tracking these logistical details through transport registries and shipping manifests, rather than waiting for official quarterly updates, which explains why the stock frequently sells off on seemingly neutral or quiet news days.
Comment below how many shares of Lucid Group Inc. you currently hold, or if you are completely avoiding this sector right now. To get a clearer picture of this friction between expectation and reality, we have to look closely at the company's core operational blueprint. This organization operates as an integrated technology and automotive designer, controlling everything from proprietary electric motor design to complete battery pack assembly inside their specialized facility in Arizona. Their commercial strategy relies heavily on a direct-to-consumer model, bypassing traditional dealership networks in favor of digital sales portals and corporate-owned physical studios. This setup is highly reminiscent of the early playbook for Tesla stock, aimed at preserving profit margins and maintaining absolute control over the brand experience. In addition to building their own passenger vehicles, they have attempted to diversify by positioning themselves as a Tier 1 technology supplier to other boutique automotive brands, signing agreements to provide high-performance powertrain components to legacy sports car manufacturers overseas. This technological side hustle is frequently cited by bulls on various individual brokerage forums as a hidden asset that could provide a steady stream of high-margin licensing revenue. However, older financial reports and historical performance reveal the steep hill this model has to climb. When the company went public through a speculative corporate merger years ago, early investor presentations outlined a production ramp-up that was supposed to reach over 100,000 vehicles annually by this stage of their corporate development. The reality fell dramatically short of those initial projections. Production bottlenecks, component supply constraints, and a series of leadership changes severely hampered early execution, forcing multiple downward revisions of annual guidance. While the company eventually stabilized its core assembly lines and expanded its product portfolio to include a premium utility vehicle, the multi-year delay allowed legacy premium brands and nimble competitors to catch up and saturate the high-end alternative fuel market. Consequently, past performance shows a consistent pattern of massive capital expenditures outstripping operational revenue, leading to consecutive quarters of multi-billion-dollar net losses that have steadily eroded the company's book value. This historical context is vital because it sets the stage for the current future outlook and the potential scenarios that could play out from here. Moving forward, the ultimate catalyst for a structural turnaround hinges entirely on their ability to execute on their upcoming mid-size vehicle platform, which is intended to target a much broader, more affordable price segment. The expectation among optimistic retail investors using services like Schwab Intelligent Portfolios or generic robo-advisors is that this mass-market vehicle will do for them what the Model 3 did for its primary competitor, unlocking massive volume and paving a clear path toward operational profitability. But the cold reality of the current market structure is that entering a lower price bracket means competing directly with established global automotive conglomerates that possess unmatched supply chain leverage and manufacturing scale. A lower average selling price will compress gross margins even further, meaning the company will have to achieve unprecedented manufacturing efficiencies just to break even on each unit sold. There is also a massive structural risk regarding corporate governance and equity dilution that every investor using a Fidelity trading platform or a basic Robinhood app needs to weigh carefully. Because operational cash flow remains deeply negative, the company relies on continuous debt issuance and equity offerings to keep its development programs funded. The majority shareholder, the Saudi Sovereign Fund, has consistently stepped in to purchase large blocks of newly issued shares to keep the company solvent. While this access to capital prevents an immediate credit crisis, it continuously expands the total shares outstanding. For individual retail investors holding shares in an individual brokerage, this means your fractional ownership of the actual underlying company is systematically shrinking over time. The expectation is that sovereign backing guarantees survival. The reality is that survival comes at the direct expense of retail shareholder value through relentless equity dilution. Looking at the absolute best-case scenario for the company, it involves a massive, unexpected acceleration in their technology licensing business. If a major global automaker decides to abandon its internal alternative fuel development and instead purchases entire powertrain systems directly from this company, it would create an immediate asset-light revenue stream with massive profit margins. This kind of development would catch the institutional short sellers completely off guard, triggering a massive short squeeze that could lift the price rapidly out of its current single-digit slump. This is the primary narrative keeping long-term bulls active on various investing sites and premium options desks, as the underlying intellectual property around motor efficiency remains objectively world-class. Conversely, the downside scenario involves a prolonged stagnation in consumer demand combined with a tightening of sovereign funding terms. If future capital injections are tied to stricter performance milestones, or if global trade barriers complicate international shipping routes, the cost to maintain their expansive retail and service network could become unsustainable. This would force drastic restructuring measures, further damaging consumer confidence and hitting vehicle resale values, which would show up instantly as downward pressure on the daily trading charts across all major platforms, from SoFi Invest to Interactive Brokers. To tie all of these threads back together into a coherent picture, the massive gap between expectation and reality is what defines this stock today. The expectation is that world-class engineering, elegant vehicle aesthetics, and deep-pocketed sovereign backing will inevitably create a highly valuable automotive powerhouse. The reality is that structural demand constraints, intense global competition, and a persistent corporate dilution loop make the equity a highly speculative, high-friction asset for standard individual accounts. When you summarize the central insights of this deep analysis, it becomes clear that this is a classic battle between an exceptional product and a challenging business model. For anyone managing their own capital through a self-investing approach or tracking sector momentum via sophisticated Fidelity mutual funds and ETFs, navigating this asset requires looking past the glossy vehicle reviews and focusing strictly on the raw cash burn rates and institutional volume trends. The technological foundation is undeniably impressive, but until the corporate economics align with the engineering feats, the stock remains caught in a structural tug-of-war that requires absolute precision and caution from anyone looking to trade it. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.